Ann Sonders, Chief Investment Strategist and Senior VP at Charles Schwab, joins us now, excuse me, by phone. Ann, what are you telling your clients at Charles Schwab today?
Well, Sarah, as I think you know, we got a bit more cautious about 2 years ago and went to what we would call a neutral tactical recommendation on U.S. equities, which just means don't get out over your skis and go above normal long-term allocations. And within that, we went to an overweight large cap, underweight small cap. So we haven't changed anything tactically in the near term simply with regard to this. But trade has been one of the bigger factors in why we have been a bit more cautious, feeling that it is the most important needle mover, in particular to define the length of runway between now and the next recession. And I think the escalation is obviously being felt. I also, though, think that, the peak in the market, the recent peak in the market on July 26th, not coincidentally, came the same day we got the GDP report as well as the annual benchmark revision. And this has not gotten enough attention, in my view, where most of corporate profits were revised away, such that we've really been in a flat trend for 5 years now in corporate profits versus the upward trend that had originally been reported. So I think that's been another factor that has caused weakness in the market that, again, has been sort of overshadowed by all of this tariff stuff.
What would turn you more positive, Ann?
Well, I'd like to see a sentiment turn consistent with what we saw in December. I think sentiment, which had been pretty subdued for much of this bull market until the end of 17, beginning of 2018, and I think that was one of the setups for the 10% correction we got in early 2018, and then the bullishness kind of came roaring back in the August-September 18 time frame, kind of perfectly setting up the near bear market we got into the Christmas Eve lows. Sentiment was so washed out, so pessimistic, both behavioral and attitudinal measures of sentiment, that I think that was one of the things that set up the subsequent rally that we got. So I'd like to see it in sentiment. I'd also like to see companies start to put some more meat on the bones in terms of not only what the current tariffs are doing in terms of impact on their profit margins, whether they're passing it on to consumers, but more telling will be what companies start to say now with regard to the next round of tariffs, which, of course, as you've been reporting, have a much greater hit toward consumer, everything from laptops and iPhones and TVs and apparel and footwear. And so I think the hit from a confidence perspective through to consumer confidence, which has been resilient, is the most important thing to watch near term.
And toys and baby products really high up on that list. So Ann, within your overall perspective here of caution, what parts of the market would you be in? Would you be in the safety plays? Would you be adding to your treasury exposure? I mean, how do you actually put money to work in that environment?
Well, we have been, Kathy Jones, my colleague, is my counterpart on the fixed income side, and they have had a bias toward the more quality end of the spectrum within the fixed income universe. So we do consistently espouse the benefits of diversification in things like treasuries. On the equity side, as I mentioned, for 2 years now or so, we've had an overweight to large cap at the expense of an underweight to small cap. And that's been the right kind of spread to play from a cap perspective. And I think that will probably persist. I think small caps are kind of in a world of hurt for a number of reasons: higher debt levels, greater percentage of companies that don't have profitability. So I think that makes sense. And then from a sector perspective, we're actually fairly neutral. We don't think you want to try to trade around this and make excess bets. We only have one outperform rating right now, which is the healthcare sector, that interestingly tends to do well when you're in a period of consistent declines in global PMIs, which we've seen a record-breaking string of decline in the global PMI. So that's our one outperform, and our only underperform is communication services. So we just think now is the time to not try to make excess bets and be also very mindful of not chasing the real defensive high yield areas. We think sectors like utilities and REITs have probably gotten a bit rich from a valuation perspective because of that, desperate search for yield that investors are in right now.
Yeah, we appreciate it, Ann, very much. Always good to talk to you, especially on days like this.